Hi, my name is Thomas Pomasa. This is my presentation on stock valuation for our Peachtree Securities Inc. Case B. The first question of the case includes find the nominal expected rate of return and effective rate of return. The second question is find the value per share on January 1st, 1993. The following was given information for question 1A. The par value was $100, dividend rate was 4.32, and the current stock price was $48. The formula for nominal annual return rate is yearly return divided by selling price. Using the given information from the previous slide, we have $100 times 4.32% equals $4.32 yearly return. We use that yearly return divided by the current selling price of $48, and we end up having 9% as the nominal rate of return. To find the effective rate of return, the formula is 1 plus nominal rate of return divided by the compounding period to the power of the compounding period minus 1. So what we have here is the calculation below. We have 1 plus 0.09 divided by 4 to the power of 4 minus 1. This gives us the effective rate return of 9.3%. Question 1B had asked us to find the value per share on January 1, 1993. The calculations include finding future value, present value, and the current book value per share. Once the calculation was done, we came to the conclusion of $203.57 as the book value per share. Question 2 had consisted of the following. What was TECO's expected rate of return at the beginning of 1992? Value line estimated TECO's dividends to be $1.80 at the start of 1992. What was the expected dividend yield and expected capital gains yield on January 1st, 1992? What is the relationship between dividend yield and capital gains yield over time under constant growth assumptions? What conditions must hold to use the constant growth model? Do many real-world stocks satisfy the constant growth assumptions? Solution for A. Constant growth rate formula. Dividends divided by price plus growth rate equals effective return rate. The calculation includes $1.80 divided by the price, $22.26, plus the growth rate of 0.06. That gives us a 14.09 effective rate of return. The dividend yield formula includes dividend divided by price. The calculations are done below. $1.80 as a dividend divided by the price of $22.26 gives us an 8.9 dividend yield. The expected capital gains yield formula is actually the same as the expected growth rate, so that will be 6%. Solution for 2C. The movement of the yield between the dividend and yield and the capital gains yield are considered to be the same under the constant growth assumption. The yields will continue to grow with the growth rate. Solution for 2D. We'll start with the definition of constant growth. Constant growth is a model for determining the intrinsic value of a stock based on a future series of dividends that grow at a constant rate. Given a dividend per share that is payable in 1 year and the assumption that the dividend grows at a constant rate in perpetuity, the model solves for the present value of the infinite series of future dividends. In the Gordon model, it assumes that the company will constantly grow. In essence, all companies would like to grow. However, in reality, there are more variables involved, including the condition of the economy, global environment, and consumer trends. These variables could negatively affect the growth rate of a company, resulting in the Gordon model not being an effective measuring tool. Of course, smaller companies are more likely to experience these volatile growth rates, when compared to larger, more matured companies. For the model to hold true, the company has to maintain a constant growth rate in both sales and assets. The company's debt ratio will also have to stay constant. Question 3 includes of the following. What was the value of TECO stock on January 1st, 1992 if the required rate of return is 13.5%? What is the expected stock price at the end of 1992, assuming that the stock is in equilibrium? The same for 1993. What is the expected dividend yield, capital gains yield, and total return for 1992? Suppose TECO's dividend was expected to remain constant at $1.80 for the next 5 years and then grow at a constant 6% rate. If the required rate of return is 13.5, would TECO's stock value be higher or lower than your answer in Part A? TECO's stock price was at $22.26 at the beginning of 1992. Using the growth rate given in the introduction to this question, what is the stock's expected rate of return? Based on the information provided in value line tables, is the assumed 6% growth rate reasonable? What has been the trend? Given value line's ROE estimated for 1995 through 1997 and the projected earnings and dividends per share for the same period, could those figures be used to develop an estimated long-run sustainable growth rate? Does this figure support the 7.5% growth rate given in the problem? Solution to 3A. To find the stock value on January 1st, 1992, we need to use dividend information provided and calculated. Use formula D6 equals D5 times 1.075. Solution to 3A. In the last slide, we seen that it was 2.4428 as the dividend for year 6. We divide the dividend by required rate minus growth rate, gives us a value of $40.72. We also add the dividend for the last year, end up with a value of $42.98. Lastly, we find the present value of the cash flows. We end up getting $28.91 as a stock price as of January 1st, 1992. Question B had asked, what is the expected stock price at the end of 1992, assuming that the stock is in equilibrium? From the previous slide, we discovered that it was $28.91 as the current price for 1992. What we need to do is add the present value of the dividend of $1.91, which is equivalent to $1.68. After adding $28.91 and $1.68, we end up with a value of $30.59. Question 3C is very similar. We use last year's ending price of $30.59. Then we add this year's dividend with the present value of $1.57. This equates to $32.16. Question 3D had asked for dividend yield, capital gains yield, and total return for 1992. Through our calculations, we came up with 7% as the dividend yield, 6% as a capital gains yield, and 13% as a total return for 1992. Question 3E had asked, suppose TECO's dividend was expected to remain constant at $1.80 for the next 5 years and then grow at a constant rate of 6%. If the required rate of return is 13.5%, would TECO's stock value be higher or lower than your answer in Part A? Through my calculations, I came up with $27.24. The present value of that would be $19.76, which is extremely lower than the $28.91 in my answer for A. Question 3F had asked, what is the stock's expected rate of return if the stock price was at $22.26 at the beginning of 1992, and we'll use the growth rates given in the introduction of this question. Through the calculations, we discovered that the expected rate of return is 18%. Question 3 had asked, whether or not 6% growth rate is reasonable. Using the value line tables, I believe it is. Tekel's current average ROE for 1989 through 1993 was 15.62%, and their average payout ratio was 67.8%. This means that 32% of the ROE goes to growth. The data does not reflect the trend, however the year-to-year performance is quite consistent. The calculation includes 15.62% times the 32.2% equates to the 5% of growth. Question 3H had asked, could the figures above be used to develop an estimated long-run sustainable growth rate? Does this figure support the 7.5% growth rate given in the problem? Using the information from the previous slide, we are able to put together an estimated sustainable growth rate. The formula for sustainable growth rate includes ROE times 1 minus the dividend payout. Using the information, we have 16.2% times 1 minus the 6% dividend payout equates to a 0.065 growth rate. The 0.065 growth rate does not support that 7.5 growth rate given in the problem.